If you are finding it difficult to mark out your liquidity side in the market, in today's video, I will show you and I will also help you in marking out your liquidity perfectly without making any mistake. Firstly, what is liquidity? Liquidity refers to areas in the market where a large number of buy or sell orders are sitting, especially stop loss and pending orders. So, in conclusion, liquidity means money. And when there's money, there's so many pending orders in that particular area. Maybe your stop loss or your pending order. So the big players, they don't place trade randomly. They need liquidity to enter any position. You understand? Without liquidity, they cannot enter or exist any position. So price is intentionally moved to those zones to trigger retail trader order and fill institutional ones. Now, for example, if you are in a particular position, if this is a demand area and you are buying in this particular position, you are buying from this particular area, and here is your stop loss, then don't be surprised that below here is where the liquidity resides. So now imagine thousands of people buying markets from this particular place, or let me say millions of people buying a particular pair from one particular area. Now probably their stop loss will be around this particular area. Yes, their stop loss will be there when many retail traders are buying from the same place, because we all trade the same thing but in different aspects. So their stop loss will be in this particular area. Then the institutional traders, what they do is they push price down to this particular zone, take everybody out and pick out every liquidity residing here before going to the normal zone, except for few, those who know how to trade structural liquidity. If you know how to trade liquidity very well, then you'll be able to milk from the market and join and also trade like the institutions. Now, before the end of this video, I assure you that you will learn how to do so. Now, we have types of liquidity. Number one types of liquidity is the buy-side liquidity. Now, the buy-side liquidity builds up between previous highs and previous low. Like for example, this is a previous high. After price has been ranging from here, this is a previous high, and this is where liquidity are residing. So therefore, this is our buy-side liquidity. And for this particular buy-side liquidity to work, we need a breakout, and this is the breakout over here. Price was clear the whole liquidity residing in that particular place. This area acts as target for price because that is where the bigger or larger volume of buy number are resting. That's why price need to target that place and take everything else. Price often move above these highs not to continue higher, but just to trigger those orders and provide liquidity to the bigger player, those who are in the market, for them to be able to sell. Now, once the buy side liquidity is taken, price will commonly shows a sharp reaction or reversal, indicating that the liquidity grab is complete, and start pushing down to the downside after everything has been cleared. Then price will start going to the main direction it was meant to go before. Now, another type of liquidity we have is the sell side liquidity. Now, the sell side liquidity builds up below previous low, where retail traders place their stop loss and sell breakouts. Example, this particular area here, this is where retail trader like me and you is going to place our stop loss. That means if we are buying from this particular area, if we are buying from here, our stop loss should be below here, below this side. Then so many pending orders of stop loss are laying down below this particular area. So what the price do? Price will move down in our direction and take everybody out, or take some of us out, before shooting up to the main direction it's meant to go. That's why in some cases, price will first of all hit your stop loss before going to your main direction. If you know, or you really know how to trade liquidity very, very well, then you will not be a patient, or you will not be a scapegoat to the market. Now, once the sell side liquidity is collected, price usually reacts sharply and reverse again, signaling the end of the liquidity sweep. Now, another type of liquidity we have is what we call our equal highs liquidity. Now, equal highs is something like this. For example, okay, let me draw a very clear thing now so you can understand. Price is breaking structure to the upside, and all of a sudden you see an equal highs like this before a break of structure to the downside. Now this is a liquidity sweep. This is an equal high because liquidity is residing there. So therefore, price swept the liquidity residing here before going down or before changing direction. You understand? So I think by now you should have understand the three types of liquidity you have: the buy side, the sell side, and the equal highs. Whenever you're in the market, you make sure you first of all locate the buy side liquidity and the sell side liquidity so that you yourself will not fall victim, or you yourself will not be the liquidity. Now, equal highs or equal lows are seen by retail traders as strong resistance or support area, because me and you can just come here and mark our resistance area, saying that yes, since price reacted here, price is going to react it again, and again there's a very high chance probability that price is going to react to it the third times. You understand? But in reality, the signal resting liquidity, multiple stop loss stacked in the same area waiting for price to be triggered, because if we are going to be entering from here, here will be our entry and here will be our stop loss, and again this is just liquidity residing here. You understand? If price should not tag you in, or if price should not hit your stop loss, just know that you are lucky that day. But don't be surprised next time price might hit your stop loss before going to its direction. Now we have 4 important liquidity zone that you need to learn. First of all is the previous day high and the previous day low. Now let's go to our chart for me to show you. The first 4 important liquidity zone you need to know is our previous day high and our previous day low. Now this is Thursday, this is Friday. This particular candlestick represents a particular day. Every price action that happened in a particular day, this candlestick represents them. Now, where does liquidity reside with this candlestick? This is the previous day high and this is the previous day low. This is where the liquidity resides. Now, if you can see, if you should fast forward down to our, let's go down to our 30 minutes time frame to see a clear visual of it. You will see that price swept liquidity, swept the previous day low liquidity. You can see that, you can see it now. Price swept the liquidity before doing what? Pushing to the upside. If you know how to trade liquidity very well, you will be having, or you will be open to so many market opportunities. Now, the second important zone that you need to have in the back of your mind is the equal highs and equal lows. Now let's go down again to our 30 minutes time frame. I saw something there. Now this is what we call the equal lows, because price has one thing in common here. These two particular man, these are the equal lows. You may see this as your demand area, or your support area, or your resistance area, but this is equal low because these two are equal, and this particular place is also a liquidity resting in that particular area. Price is still going to come down and sweep the liquidity residing over here. So now, for example, you wanted to buy from this particular area and your stop loss will be in this particular side, will be here. Don't be surprised, and your TP should be above here. Don't be surprised that what price will do here is price will go down, tag you in, give you a little profit to be happy, and sweep the main liquidity. After price has swept this previous low liquidity, price will start going to its preferred direction. Then you'll be stopped out and you'll be crying that you have lost your money on that time to the market. The third important zone for you to know is imbalances zone. Now, example of imbalance. Imbalance can be seen as fair value gap. Now, if looking at my chart right now, you can see a very sharp fair value gap over here, from here to here. This is our fair value gap. Now, have it in mind, imbalance zone reflects areas of thin or inefficient price action, usually created by sharp move. Price tends to return to those areas to fill in the order. Now, this particular fair value gap is being created by this very long or very big impulsive move, and this particular impulsive move is being created by the smart money, and again they leave traces, which is this FVG, and again an order block over here. Now you can see what price did to that particular order block. Price, after cleaning out the whole fair value gap over here and also our liquidity residing here, price did what? Price tapped into our order block and start dishing to the downside. If you know how to trade this very perfectly, this is a clean setup for you, and probably you will be in a 1:2 or 1:3 risk to reward ratio. Now another important zone is our order block. Now order block is also a place whereby liquidity reside, because mere looking at this particular chart, everybody know how to trade order block, and so therefore if this is our order block, what 90% of traders will be doing is entering from this particular place and setting their stop loss above this our order block, maybe here, forgetting that we have this buy side liquidity over here. These are buy side liquidity over here. So maybe newbie, if you don't know how to trade liquidity, you might be setting your stop loss. They say set your stop loss above your order block. You might be setting your stop loss above this particular man over here. And just know that if this is you now in this particular scenario, you are lucky to be able to be print this particular profit. It will not take long before market catches up on you. Now what price will do here is just go back up, take you out, clear this buy side liquidity before coming down here and start going to the direct direction. You understand that? So if you want to trade this particular setup perfectly, your stop loss is either your stop loss is above here, which is what I advise. 25 pips, yeah, it's too small. 25 pips is okay. So your stop loss will be there, and your TP should be below the previous day low, which might be this particular guy over here. So as easy as this. See you guys in the next video.